financial models have become the most important decision-making tools in finance. FMI is the world's only financial modeling accreditation body. FMI's accreditations empower finance professionals to strengthen and validate their financial modeling skills. Learn more by visiting fminstitute.com today.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about the global landscape with Marvin Lowe. He is a senior global market strategist with the multi-asset research team at State Street Global Markets. On his team, Marvin's primary responsibility is to leverage State Street's proprietary institutional behavior, risk, and inflation metrics to monitor the market's developments and formulate their impact on global currency and interest rates. He obtained a Bachelor of Science degree and an MBA degree from New York University Stern School of Business. So welcome back to the podcast, Marvin, I should say.
Nice to be here, Rob, as always.
So let's start with the global currency markets because things have been happening. How are you seeing things now?
Yeah, for sure. So, we started the year with the central banks and the thoughts around the central banks being central to the entire discussion. So early on with expectations that the Fed was going to cut aggressively. Remember, we were thinking that they were going to start in March and we're going to have 7 cuts this year. Well, obviously that didn't materialize as we're still waiting for the first cut. But, we had a weaker dollar response as a result of that. As the Fed ultimately needed to kind of pull back the rhetoric that was making its way back into the market, we saw some dollar strength. And ultimately, we're seeing that dollar strength continue as we go into the summer, maybe for different reasons at this point. Certainly the cutting cycle is in investors' mind, but really some of the political uncertainties that have arisen makes the dollar an easier type of security to ultimately buy within the FX market, particularly when we compare it to maybe the euro, which is going through some of their election concerns, and the emerging markets, which have been under a lot of pressure given the wrath of unexpected election results that have emerged out of that.
Yeah. There's, in addition to the things we expected being the elections, there's been a lot of unexpected outcomes. Can we zero in on Europe for a second?
Yeah, for sure. So, a shot across the bow if you were expecting low volatility to continue across all asset classes. France is going through a fairly significant election process right now. As we speak today, we know the results of the first round. There's going to be a second round. I think the betting is that you're not going to have a coalition. You're not going to have the far right ultimately in a position where they control everything. There's going to be some coalition, and maybe the worst concerns of investors around a sweep from the RN party is going to be avoided. Kind of having said that, there are still a lot of questions as to how all this evolves over the course of the next several years, because the French elections, granted they're several years away, this might be a look into how that might evolve.
Right. And I noticed that a lot of investors over the weekend were pointing towards the possibility of a scenario like the one in Italy evolving around that with a conservative prime minister who has a coalition a lot of people thought wasn't going to be durable, but has been.
Yeah, for sure. Certainly a different political structure in Italy versus France. The prime minister has a different role. The title of the prime minister has a different role in both of those countries. One of the things that we got out of the Meloni administration in Italy was that they did need to ultimately come to the table and somehow play ball a little. So, I think that we sometimes as analysts, we're paid to really understand the entire gamut of risk, and the worst case scenarios are something that's always in the back of our mind. The media certainly grabs hold of that. Italy did not wind up as extreme as that. Kind of having said that, I think that maybe some of the worst cases around the RN in France might not be as significant as the worst case, but you do have this wave of populism that's making its way across the globe, including what we're experiencing here.
Yeah. So how do you see that wave impacting currencies and rates?
Yeah, rates, I think, is the primary asset class that's responding the most at this point. I don't want to make too much out of one day of trading, but after the debates last week, again, timestamp that we're doing this on the 1st of July.
Right. So that first round of French, let's see, it's almost noon on the 1st of July. So that first round of French voting only ended about 18 hours ago.
Exactly. So this is real time. You've got us reporting news as up to date as possible. But a day after the debates last week, at least in the U.S., we had a widening of U.S. yields. We had higher U.S. yields surprisingly, actually, given the inflation number that came out that same day. So I think that rates are going to be something that investors pay more attention to, particularly from a duration perspective, which might get more impacted by a lot of additional debt, or kind of how some of these populist governments might want to approach their fiscal approach. Now that we're really past the point of being comfortable that rate cuts are coming, I still think that hikes are off the table, so we're just waiting for them to start. But that's the next part of the process. It gives us the ability to really think about where they settle once we're done, and what type of political environment these central banks are going to be dealing with once they're at that point in the process.
Right, because that's one of the other shoes to drop is, in addition to the politics, we just talked about some very different economies with very different problems.
For sure, for sure, for sure. The idiosyncrasy of these different economies, the unique natures of their demographics, as well as their growth profiles, are going to change the approach of each one of these central banks. We've been waiting for this policy divergence for, at this point, well over a year, and we really haven't gotten it, at least from a market perspective, in terms of separating these different markets from an FX perspective, at least, kind of thinking through 25 and the different challenges that each of these countries have. We might actually start to see that divergence make its way into the markets.
Interesting. So, do you think the issues that are surrounding duration that you just mentioned, do you think at that point they change also?
Yeah, I mean, so, I've been on a bit of a soapbox just about debt sustainability. I do think that it's an important discussion with regard to what the 10-year yield, if you will, is supposed to trade at. The amount of debt that the U.S. is dealing with is somewhat unique, because we certainly have bad actors in Washington that don't seem to be willing to address it. But just the amount of debt that all of these countries have after the pandemic makes the amount of flexibility that each one of these countries ultimately have in dealing with their fiscal situations much more challenging.
Right, because the UK's debt is also substantial. There are other developed countries, but that is always based on the fulcrum of what is the earnings capability and therefore the taxation capability.
Sure. GDP profiles are important from that perspective.
So it's gonna be interesting. Do you expect anything else from the continuance of populism to impact rates or currencies or others? Do you want to zoom in on any smaller countries, or do you want to talk about Latin America?
Yeah, I mean, certainly rates is again where I think most of the shock absorbers are happening, if you will. The cross section of concerns are making their way through that asset class first, but it will ultimately play into rate differentials. So currencies, for sure, look into that. It's one of the reasons that I continue to think the dollar has some firm footing in this market at this point. And depending on how much of an inflation impulse, let's say, some of this populism generates, and we'll need to see that, particularly as we go through the disinflationary aspects of global inflation at this point in time. So things are looking good from an inflation perspective, but are they going to get where a lot of the central banks expect them to get to? If they don't, then you're going to have certainly different sectors and different companies respond differently. Whether it's from their borrowing needs, whether it's from their earnings capability, or whether it's the discount rates that kind of feed all the CAPM and discount dividend models that all of the equity analysts use.
Well, right, and that also begs the question: is if your goal for inflation is 2% and you're 2.4, is that good enough?
You know what? That's a great question, because I think we're going to be dealing with that fairly soon. Because my view is that inflation will probably be a little bit stickier. 2.4% is not terrible, to be honest with you. And in a lot of ways, the rates market, from kind of a five-year forward market pricing, is expecting that neutral rate to be higher than what it was. If it's stable, it's not terrible. A certain amount of there's nothing magic about 2%. Number one, a certain amount of inflation is healthy for the economy, and it's something that's hard to accept given everything that we're dealing with from an inflation perspective right now. But if it's stable, then companies, purchasing managers, they can make, and consumers for that matter, they can make decisions around what they want from wages, how much they're willing to invest in capital. If we get kind of this mid 2%, 3%, but it's volatile, then it becomes a little bit of a challenge. Then we get into higher inflation, a premium that we need, the whole term premium discussion that I spend a lot of time on. Then it becomes a bit more challenging. And For the U.S., given the amount of debt that we have at the federal level, it becomes incredibly challenging. So some of that volatility begets volatility in my mind.
Right. It is an overhang on that. Let's do maybe, take this up a notch to where we are in the credit cycle then, because we sort of started talking about it. But the debt is one thing, the cycle is another. So where are we in the current credit cycle?
Yeah, so I mean, we've had a lot of certainly concerns within the banking system over the course of the last year and a half, if you will. Early in 2023, we were dealing with SVB, First Republic, a few other banks that failed. More recently, we saw some strains in a local New York community bank. Different reasons that drove each one of those stories. I had always been of the view that there was some idiosyncratic aspects of how they ran their business model. And it does seem as if that's the case. Having said that, we are very late in the credit cycle, and Fed tightening is supposed to ultimately take credit out of the system. And we did see that over the course of the last 12 to 18 months. Banks seem to be stabilizing. There is a vast difference between the big banks. The Fed provides that weekly banking balance sheet data, and they just say big banks versus small banks, about as benign of a description as you can get. Well, big banks are the GSIBs. They're the top 20 banks. Everybody else is considered a small bank from a Fed perspective. So there's a lot of banks in that small bank. We're seeing different behaviors. So remember that a year ago, we were concerned with deposits. That's really what drove the SVB concern. Right. Banks went out and tried to grab deposits because they didn't want to be in a similar situation. They wound up buying those deposits, ultimately, locking in some more CDs, what they call time deposits within that Fed data. Brokered deposits also hit levels that we had never seen before. So there is still that degree of behavior going on across all banks. So while overall deposits are stabilizing and firming up, particularly for the small banks, we are seeing that they're costing more money. So the NIM gets impacted by that. But, live to fight another day. Ultimately, if they could stabilize their deposits, they can get to the point in the cycle where they get more comfortable. Well, it seems over the course of the last quarter to 2 quarters, they've gotten more comfortable on the lending side of things. But even there, we're seeing difference in behaviors. Big banks seem to be spending all of their kind of, if you will, newfound additional capital in the securities market. So loan activity from the big banks seems to be fairly flat-ish, if you will. But they're buying securities. So that certainly is an affirmation to potentially a Fed cutting cycle that's about to begin. Maybe they're making a view around that. I would also say that their approach to securities that they owned was probably very different than what the small banks were doing. So remember, a year ago when we were dealing with the troubled regional banks, it was because deposit strains was creating problems for the asset side of their balance sheets. They couldn't sell their assets to kind of refill their deposits, if you will. And one of the big issues was that they owned a lot of securities, and those securities were put into this held to maturity portfolio, if you will. They didn't hedge it, which, ultimately everybody who's listening to this is going to scratch their head. Why didn't they hedge it?
Well,
my guess is that the big banks did hedge it. Remember the type of banks we're talking about. So maybe they have more flexibility to add duration to their securities portfolio, and they're seeing levels more attractive, particularly maybe on the MBS side of things. Small banks, they don't have that flexibility, in my mind, probably because they didn't engage in much hedging activity. So we're seeing on the asset side of the small banks growth in commercial real estate again, surprisingly. Maybe some growth in residential real estate, but I was surprised when I saw the data that they're growing their CRE books again. All the other categories, they're very consumer-driven, credit cards, car loans, student loans, all those things. They seem to be somewhat flat between both big banks and small banks, which speaks to maybe some of the consumer strain that's out there.
Yeah, well, so commercial real estate is a couple of different things, right? It's not just office. And I know that, the performance of logistics around ports and stuff like that had done exceptionally well. Mm-hmm. Some of the other industrial subsectors had done very well, and some of the housing was doing great. Some of the housing subsectors, like student housing, were doing absolutely phenomenal. So I wonder if they're adding to those. This is where you step off in the Fed data a little. It's hard to tell.
Yeah, it could be, and it is hard to tell, and to paint everything in a single stroke is always a bit of a challenge. There certainly might be opportunities around it. I do think that as many good sectors as there are within kind of this broad CRE category, there are probably a decent amount of challenge sectors. And those challenge sectors, kind of given the way a lot of these loans are structured, need support. So I'm sure it's a little bit of both. Where there is an extend and pretend type of environment that exists, particularly if we're looking at a Fed cycle that's going to get to cut soon. There's always the hope that it's gonna save some of these portfolios that might be challenged. One of the things that I would be concerned with is that the response to the banking stress last year was really a bazooka from Treasury, the Fed, and the FDIC. Pretty much guaranteeing deposits. They won't say that. Certainly, Treasury Secretary Yellen was pushing back against that. But there's got to be, in my mind, some moral hazard if you're bailing out SVB's depositors, which are very much large institutional tech investors for the most part out in California. How are you not going to bail out other depositors in middle America? So does it give these regional banks or these smaller banks a little bit of leeway in terms of aggressively approaching their loan portfolio because there's a moral hazard that's been created by what these federal authorities did last year?
Right, or a lot bit of leeway. Well, because it's not just there, right? We first started talking about the moral hazard of bailouts in the financial services sector during my time in 2009.
My time too.
So in 2009, that was where we started talking about this. And what we've had since then is a massive expansion of Tobin's Q, right? for years and years and years. So if we have a certain amount of turnover at a company, and some of those people have experiences that are only limited to that time period, why would they think there won't be a bailout?
Yeah, exactly. And we would need more time than we have for this podcast, but I believe that unintended consequences since the GFC, whether it was from the Fed, whether it was from various regulatory agencies, whether it was in terms of a market structure perspective, has really impacted how we've evolved during this cycle. So it wouldn't surprise me if what we've done over the course of the last 3 to 4 years around the pandemic is going to create some unintended consequences as we wind up on the other side of the cycle.
Right. And, I hate to circle us back to your soapbox, but let's do it. Most of that was deficit financed.
Some of it certainly is the deficit financing for sure. And, we're going to have, from a marketable treasury perspective, debt to GDP over 100% next year. Some of the data that we've run is frightening with regard to the amount of interest that it's going to cost the U.S. government. Like you said, you and I have been around since the GFC, if not before, and we've heard from deficit hawks all along that period. But really, the numbers are frightening because I think the actors in Washington are behaving very, very differently. And the one thing that I point to is the primary deficit. Let's not even look at the interest component. The primary deficit during periods of above trend growth, which is what we've had, should be minimal to negative, quite frankly. We're running 2% primary deficits and expecting it to be at least 2% for the next 10 years forecast period. I don't see any conversation coming out of Washington looking to reduce that number. And then when you layer on an interest component that's bigger than the defense budget, it gives you a sense of what we need to deal with. Is this the Rubicon at this point? Did we cross that line? We'll see. There's a lot of concerns that I have, which has really guided my view not to be overly aggressive on duration for the last several quarters as I kind of looked into this.
Right. And I also find this a little bit confounding because the bond market didn't decide to go after the UK until Liz Truss started talking about trickle-down economics.
Yeah.
That had been a situation we'd all known for years before that.
Yeah.
But there was that one thing, and then boom.
Yeah.
So,
I'm careful in using the Liz Truss moment for every bond market because the gilts market is nowhere near as large and robust, and there was a series of derivative products that were structured in that market that kind of amplified what we wound up dealing with there. Kind of having said that, it should act as a reminder as, we as professionals really think about what our asset allocation approach should be, around fixed income. Does it provide the hedge that it used to? And then as important, are you being compensated? Is the term premium, which right now is negative, are you being compensated for the risk of everything that you and I are just talking about?
Right. That's the thing where it comes back to CFA New York members is how you're thinking about this on behalf of your clients. Because all of this should file into your bond allocation and what your clients' needs are from that.
Absolutely.
Because
Absolutely.
the stock market seems to be doing well, Nvidia is doing well, but it's a tough job to have.
It is.
Thank you for helping us through it, Marvin.
Appreciate it. I always enjoy my trips to New York and sitting down with you, Rob.
And thank you all for listening to this podcast. Until next time, I'm Rob Rowan, and this has been Compound Insights.